And overall, if you miss a leader, I miss leaders all the time. If you miss something, just study it and try to distill, what made you miss it? What can you improve the next time? Because every single year there's going to be 20, 30, even 50 names that give really good opportunities to move the needle. And if you miss one year, you can catch, many others down the line by studying why you missed that stock. So then you can apply that blueprint to the future and just, again, consistent improvement over time. Remember, the goal is to trade for decades. We don't need to make, our fortune all at once. Remember, then when we feel the need to force things in the market, I need to force myself into this position. It's likely the wrong way to go, and there'll be a better opportunity in the future. Like weightlifting, you must earn the right to increase position sizes. You have to build that up over time. Once you're kind of in stage 2, stage 3, then you can start saying, all right, I'm going to slowly increase my max position size I can take. I may increase my risk slightly in the best environments.
System hopping is essentially randomness, and randomness is a barrier to your success. One example is Dan Weinstein. He's refined that same system. The core of it's still the same, but he feels the market's now moving a lot faster. He's looking at the daily charts more. He's looking at the 50-day more, right? He didn't go, okay, I have this system now, I have to start over to go try some other thing. He still sticks to stage analysis. He just adapts it.
Improving risk management. This is, something we mentioned multiple times is key to progressing along your trading journey from stage 1, 2, 3, 4. With every setup and trade that you make, have a clear stop loss and position sizing rules that fully define how you're managing risk for that trade. Again, for a more volatile name, you might need to manage risk more through position sizing than your stop loss. They kind of go hand in hand. Together, they form the max loss that you can take on that position. If you have 100K that you can trade, whether it's a margin account you built up or a Roth IRA or whatever, when you're building your process in stage 1 and stage 2, trade 1K of that. Trade something where you feel losses, but if you lose that account completely, you're not setting yourself back financially, because again, it's about process over performance first of all. The next section is on common trading problems, and these are things that we've realized and seen over and over after mentoring thousands of traders. And these are the common things that traders come up with, especially when they're stage 1, stage 2, trying to transition to stage 3. So we thought we'd address a few here and kind of think of, give you guys frameworks about how to solve these and think through what's actually the root cause of all of these. So here's a list of some of them: system hopping, FOMO, oversizing, buying extended, buying late. This is an issue I had early on. Overtrading, too many indicators, randomness, lack of risk management, overconfidence, no sell rules, underconfidence, no post analysis. There's a lot of others we could have named here, but in the chat right now, and you're in the YouTube comments, if you're watching the recording here, I want you guys to list out kind of the top 1 or 2 that you're experiencing, over and over right now that you're currently dealing with. I think overtrading is a common one for stage 2 traders, where it's about that kind of lack of awareness about the market environment too, is they're trading too much in a choppy downtrading environment. So this is a kind of a key one for stage 2 traders. I think everybody experiences FOMO to some extent. It's just about the seat time and realizing there's so many opportunities out there. And then system hopping, I think, is really occurrent in stage 1 traders. But let us know in the chat here what you're mostly dealing with. Let's see some of the responses. System hopping, FOMO, overtrading. A lot of people saying overtrading, buying extended late. When we cover our edges and setups webinar and entry tactics, we'll address that specifically. Need to do more post analysis, overtrading, FOMO. So it sounds like a lot of you are experiencing some of these: FOMO, overtrading, buying late, buying extended late, FOMO. Awesome. So this is completely normal. I don't want you guys to feel alone about experiencing this. Again, it's just part of the transitions between the stages and where you're currently at on your journey when you go through these. Before we get into specific ones and how to kind of work towards improving them, Ryan, anything you want to mention in general about these issues that traders might be experiencing?
No, I think it's important to just write down what you feel is stopping you from being successful, right? It all comes back to, st self, looking at what you're doing. Um, and, if it's multitude of issues like that are listed on this slide, then you need to start to work towards each of them. And how do you kind of build out a plan, right? On how I will stop randomness, how I no post analysis is just like you just have to do it. There's And a lot of traders don't tend to do it. So I don't have really much to add other
Yeah.
than, the fact that people are saying that they have these is the first step to doing anything about them.
Yeah, and actually the first thing I want to say before we get into specific ones is as a whole, I think a lot of the emotions that come with trading, the FOMO, dealing with oversizing, all of that, I think a lot of it stems from, at its root, like a lack of clarity about your system and almost a lack of trading rules. So if you're experiencing a lot of FOMO, double check that your rules are up to date. And this is kind of an assignment for you watching this. This weekend, go ahead and update your rules if you haven't yet or haven't, recently. Because I think a lot of emotions come into play when there's confusion with yourself about your objectives and what you're trying to do. And it just takes, figuring that out, realizing exactly what your setup is, what your entry tactic is. That clarity gives you confidence and gives you perspective. And if the environment isn't matching what you're looking for, you actually understand, there's no FOMO even if a stock's up 5% off the bottom, because that's not my spot where I like to enter. I wait for the higher low. I wait for the moving average reclaim. I wait for the breakout. Whatever the setup is, and have confidence in what you're trying to do. So just moves off the bottom or big moves up don't really kind of phase you because you have that clarity about your objectives and all of that. So I think a lot of emotions that come to trading can be helped or managed by gaining more clarity about your system and redefining your trading rules for yourself. But first things first, getting into FOMO. Actually, that's exactly what I just said. If you're experiencing FOMO, I think just getting clarity about your trading system is really important. Setting process goals and realizing that you just need to focus on the best opportunities each year, and that there's so many different ways to get triple digit returns or even 40% returns. And there's so many opportunities every single day, every single week. During a typical trading year, there's like 2 to 3 periods where that's really where you'll move the needle in your account if you catch it. And realizing that a lot of the rest of the time and a lot of the rest of the movement doesn't really matter and impact you. I think also when it comes to overcoming FOMO, just studying the market and previous market leaders and recognizing that even if you miss the first breakout, if you keep an eye on that stock, there's going to be a pullback setup. There's going to be a future earnings gap. There's going to be another base that forms. If a stock's going to go 1,000%, like we saw Nvidia or PLTR, do the past 2 years or so, and there's examples every single year. There's so many different setups along the way that you can catch. So even if you miss the first opportunity, there's going to be another one in the future with that stock or a completely different stock that has an equal potential as that one. So just recognize that the opportunities are endless. There's going to be multiple times to get in, and often that breakout that looks so good will just pull back and retest the pivot, over the next week or so. So just keep an eye on that stock. If you miss something, just be patient and wait for a spot where you can manage risk tightly and logically. In addition, establish a clear daily routine. If you miss, for instance, an earnings breakout, an earnings gap, and you just saw it late or you saw it, after the close that day, look at your routine. If your routine has nothing about scanning the market pre-market for big volume moves and gap ups in the morning that will be potential earnings gaps, or the previous day you didn't have anything in your routine about scanning post-market, looking for earnings beats, news catalysts, whatever, then you can't be mad at yourself for missing an earnings gap the next day because it wasn't part of your system to look for it. So if you're experiencing FOMO because you missed a setup that you think you should have gotten, make sure to look at your system itself and see, do you have it set up so you could catch that stock. So that's another thing. Make sure you establish clear daily routines, and that goes along with building your system as a whole. And overall, if you miss a leader, I miss leaders all the time. If you miss something, just study it and try to distill, what made you miss it, what can you improve the next time, because every single year there's going to be 20, 30, even 50 names that give really good opportunities to move the needle. And if you miss one year, you can catch, many others down the line by studying why you missed that stock. So then you can apply that blueprint to the future and just, again, consistent improvement over time. So that's kind of a few things on overcoming FOMO. Right? Anything to add on this slide from your side?
No, I think that nails pretty much um, everything. I think there's also the fact that traders use social media quite a bit now, and they
Yeah.
have access to other people that are consistently, doing great. regardless, or are doing better than let's say if I'm in a series of losses and nothing that I do is working and I see someone else in the same situation, like in the same market doing really, really well, that induces FOMO quite a bit. Naturally, right? Is it something I'm doing wrong or what's happening? So it's important to realize that there will always be successful traders in every type of market, but that doesn't mean that you have to be successful in every type of market, right? So
Yep.
there's a bit of that you have to realize as well. It's a good opportunity to learn what those folks are doing, and if there is a way to learn what they're doing, to be curious about it. But I don't let it get to you that, in a choppy or downtrending market, why am I not up 60% on the month? Well, it might just be that you're stage two and stage three, and they're stage four, and have been trading for 25 plus years, right? So there's always context and reason to things. And I think, there's a quote out there, comparison is something of joy or something like that, killer of joy. Exactly what it is these days with social media and all that. So just keep perspective, is the only thing I would add. There's always a successful trader in every market environment, but that doesn't mean that you have to be really, really great at every market environment. So.
Yeah. And by the way, along the lines of trading rule set, we'll be sending out, along with the book, a sample trading rule set. So I see a lot of people mentioning that. Sign up for the wait list, the interest list, and that will be one of the bonuses that you guys get. So definitely go ahead and do that. All right, improving risk management. This is, something we mentioned multiple times is key to progressing along your trading journey from stage one, two, three, four. I think here's some practical things that you can do. With every setup and trade that you make, have a clear stop loss and position sizing rules that fully define how you're managing risk for that trade. Again, for a more volatile name, you might need to manage risk more through position sizing than your stop loss. They kind of go hand in hand. Together, they form the max loss that you can take on that position. I think a good starting point, I think most people say 1% to start with. If you're very new, I think, this is a better metric to shoot for because it just lowers your risk overall. But, how you calculate this is basically the position size in dollars multiplied by the stop loss risk on that position, and then convert that to percentage of your total account. And that gives you the percentage that you're risking on any one trade. And even with 0.5%, you can have big sizes if you're keeping your stop loss pretty tight. So don't feel like this is too restrictive and doesn't allow you to perform later on. I think Marius Samatudis, who I've talked about quite a bit, we're doing a boot camp right now. He actually, used to use about 0.5%, but now looking at his stats and looking at his performance and all of that, he's actually lowering it to 0.3% of his account on any single trade, which is pretty tight. And the reason he does that is because he uses pretty tight stops, so it still allows him to, position size pretty big. So I think this is a good rule of thumb to start with. For your top trading ideas, identify in advance. This is just part of creating a trading plan, the tight and logical stop that you will use. Set stops right after you buy in with your broker. I think a lot of beginning traders, just have mental stops, and I think you just haven't earned the right to do that yet. A trader like Rye or Oliver, Oliver actually uses mental stops, but he knows exactly what his max pain stop on a particular day is, and he has a discipline to apply it when the stock hits it. So, you aren't Oliver Kelly yet. You have to work towards that and earn the right. This is just kind of a routine type thing. Each morning and night, check your stops to see if they need to be updated. I think sometimes there's just complacency where you have an updated stop and the stock pulls back, breaks where you should have had your stop, and you have a much bigger than expected loss or drawdown off the top just because you didn't do your due diligence and manage your portfolio correctly. So this is kind of a routine type thing, and I think all of these are kind of very practical and something you can apply right now to improve your risk management. And lastly, this is just kind of a way of thinking about it, a mindset shift. A stop loss is a good thing. A stop loss when you buy a stock, your stop loss is basically the amount you're risking is your ticket to actually try that trade. It's your insurance that protects you if the trade goes against you. And the best thing about trading is sometimes you get a ticket refund if the trade works in your favor. So don't view a stop loss hit or the potential your money that you're risking on a stop loss as a negative thing. just treat it as the cost of doing business. You have to protect your downside. It's just the price you have to pay. And that with that mindset and knowing that a successful trade can pay for many tickets and many stop loss hits, it just gives you that kind of confidence again that a stop loss hit is a good thing. If I get a stop loss hit, that's a well executed trade for me, even though it was a loss. I think too many people view success or failure based on whether the trade was a winner or a loser. Really, I think you should reframe it on how well did you execute. Because even a winner could be a bad trade if you manage it incorrectly, and a loser if you follow your plan and use your stop loss and take a stop loss hit and go out of it with a small loss. That's a very well executed trade, and that should be commended. So again, just think of a stop loss as your ticket for doing business. Rye, anything that you want to add here on risk management?
Yeah, I think bull markets make traders lazy, where they feel like they can get away with doing things like not knowing exactly where they will kind of, you know, take that loss and move to the next trade. A longer bull market kind of does that more and more. And when the trend reverses and things change like they have even recently, I see a lot of, oh, I had this rule and I didn't follow it anymore type of situation because the market was so nice and trendy last year, like likely just like a sideways S, right? We pull back, we go up, we pull back, we go up, we pull back. So it put a lot, you don't want to kind of go into these bad habits just because the market's playing nice with you, right? We always want to remember this that 90% of traders will likely not make money in the markets, and that's because of complacency, lack of risk management. Regardless of the type of market we're in, those things have to be consistent for us to be stage 3 and 4. So, yeah, that's the only thing I want to add there.
Yeah. So the next one, system hopping. Again, I think this is more of an issue for stage one and maybe early stage two traders. It's before they kind of set for themselves, this is my style, this is what I'm going to do. And the first step to do this is just, again, pick a trader or pick a system, pick a methodology that makes intuitive sense to you. I interviewed a lot of traders, and William O'Neill's work was the first one that really just kind of made sense for them. And they might not trade exactly like O'Neill now, but that's kind of their foundation that they built everything upon, and they of course made tweaks to make it more suitable for them. But identify a single system that makes intuitive sense, pick that one and just say, all right, I'm going to get my PhD in swing trading pullback setups. That's my focus, and it should match kind of your style, your personality, your time constraints as well. Many of you are probably working full time and might not be able to day trade all day, or even really actively swing trade, or maybe you can only watch the close, so you have to adapt a strategy that works. A lot of position management at the close. Just pick something that works for you and stick to that so you can become a specialist in it. And again, it's just important to recognize that not all styles work well all the time. There's going to be, again, 2 to 3 periods a year where, really the methodology that we use is really excels. And recognize, again, that specialists get paid in the markets. You only need one style to become incredibly wealthy at this. Focus is much more effective than trying everything out at once. This is true in trading. This is true in business. All of this. Commit to a style, one setup, and work towards mastery. I think that's the biggest takeaway we can give you guys. And if you are system hopping, just make a contract with yourself for 3 months, for 6 months, whatever it is. I'm only going to trade this way, and I'm going to ignore, trying to trade shares, trying to trade options, trying to trade futures. It's not just styles; it's instruments as well. I've been talking to a lot of Trade Lab members over the past few weeks and months, and a fair number of them, a big issue they're dealing with is they're trying to focus on mastering options while also swinging shares, while also investing in ETFs and managing 5 accounts at once. Focus on one system and one process makes it a lot easier to improve at that skill and improve at that system. Ryan, I think you've probably got some good thoughts on this. Anything you want to add?
Yeah, I think system hopping is essentially randomness, and randomness is a barrier to your success. So, a few good examples of this would be even myself in the early days, I tried everything and I kind of learned my lessons that way. And it got me to be successful only 8 to 10 years later, right? Whereas if I actually sat and focused on one thing, not trying to trade derivatives of oil or Forex or trying to look at the market from a news perspective, if I did one of those, and only did that for a long span of time, I would have gotten to where I wanted to be a lot quicker. So it's just a lesson that many traders, even market wizards or folks that build their own systems or cycles, they stick within that system and cycle that they've built, and they continue to refine that one thing in an iterative way over the years, right? One example is Stan Weinstein, the book that he wrote over 25 years ago now. He's refined that same system. The core of it's still the same, but he feels the market's now moving a lot faster. He's looking at the daily charts more. He's looking at the 50-day more, right? He didn't go, okay, I have this system now, I have to start over to go try some other thing. He still sticks to stage analysis, he just adapts it. He adapted it to the current market, and he didn't system hop from one thing to another. He's been doing the same thing for 30 plus years now, right? And he's mastered that. His feel for the market, his feel for tape reading, what he sees and the observations that he's making are so consistent. Even though some folks might say, "Oh, that it's not the perfect system," or whatever the case might be, but it's allowed him to be profitable for over 3 decades now, right? So um, that's a lesson in and of itself. Uh, the biggest, most successful traders are refining what they have as a system instead of completely scrapping things every few years or every few months and going to something new. So
Yep. Oversizing. Again, I think this is an issue for stage one. They hear an idea on Twitter and they just like, all right, this is my path, my ticket to success. I'm gonna go all in or put most of my account in it. Um, that's just kind of over time, again, over time, over a series of trades, a recipe to have a really large drawdown and probably quit trading and stop trading because you just don't have the capital. So I think some practical things you can do: outline the max position size and max risk you can take on a position, and determine really clearly for yourself in your rules how you determine position sizes for new trades. And if a trade that you come up with, you calculate where your stop loss would be, what your position size, and it's outside of your parameters. You just simply can't take that trade or take that trade with that size. Remember, the goal is to trade for decades. We don't need to make our fortune all at once. Remember, then when we feel the need to force things in the market, I need to force myself into this position. It's likely the wrong way to go, and there'll be a better opportunity in the future. And I said this earlier, like weightlifting, you must earn the right to increase position sizes. You have to build that up over time. Once you're kind of in stage two, stage three, then you can start saying, all right, I'm going to slowly increase my max position size I can take. I'm going to increase my risk slightly in the best environments. Another practical thing that you can do is track your total open risk, and we actually show you guys exactly the math in the Trader's Handbook. It's basically just determining what is the max loss you'll experience if all your stop losses on all your positions currently gets hit. And if you track this number and realize where we are in the market cycle and what that number should be, depending on where we are in the market cycle, it can really protect you when the tides turn and we enter a new correction and prevent you from kind of oversizing, over trading at the wrong moments, at the wrong times of the market cycle. Right, anything you want to add on oversizing positions, sizing too much?
I think what you said with weightlifting is key. You have to have reps to build size, and you can't just pick up a 100-pound dumbbell and start trying to do something with it. So there's progression to it. Every time you see someone else size heavily, it's because they're confident or they're irrational. But you have to be rational about your approach in the markets. You have to be risk adverse. You have to come to terms that this is not a lottery ticket that you're buying. And it's going to take multiple trades over a span of years for you to see that, equity curve rise steadily, right? And over time, if you survive, you'll also have luck and you'll catch ginormous gap ups, which will boost your confidence, or maybe even make you overconfident sometimes. But it will allow you to stay in the game, right? And wrong or incorrect oversizing or social oversizing when you're looking at someone else and you want to mimic them, doesn't work, because there's emotion involved. There is um, decision making involved that you're not ready for, or you may not be ready for just yet. So, if you're at 6 to 7% position size, take that to 8 to 10 and see how you respond to it emotionally.
Yeah.
If you respond to it well and you're still making the same decisions and you're consistent, then the next step is 10 to 12, right? And then you step towards um, that size of 25%. A lot of traders and me and Richard, when we do these webinars, we always get the question, how do you position size? How much are you position sizing? I want to copy what you're doing. I can position size at times as much as, 40% in a single name. But I don't think another trader, if I say 40% and they do 40%, I will manage it much better because I just have built it, right? I can sit here and really, even if it goes against me, I can sit here and stomach that. Whereas Trader B might even not even know what to do, right? So Richard, like for you, as you started, maybe,
Yeah.
you didn't start at heavy size. You probably started at 4 or 5%, 6, 7%, 8, 9%. Then you worked your way up to it. So that's the biggest lesson here. You can't copy position sizing. You have to, you know,
Yeah.
go through the reps to build it. So
When I started, from what I learned through Dr. Wish, I started with about 10 positions in a portfolio, 8 to 10% in it. But over time, as I talked to more traders and built my confidence, built my system, used smaller stop losses, now kind of my goal is to split my portfolio into 5 slots of about 20% each. And I might size one name a little bit higher, a little bit lower, go on margin two. But, my desired position size in a leader, I want to get about 25% in, the leader, the top three names. But again, I'm managing my risk as I do that, and I understand when to do that, what markets part of the market cycle to do that, how to set my stop loss, where to set my stop loss, all that stuff. So I think oversizing comes from seeking performance too early in your trading career, where stage one, stage two, and even the first half of stage three, it's really should be a focus on process over performance, building the habits, building the technique, so you're able to handle this, increased sizes and all that. So I think this is really important. And if you're someone who oversizes, just be honest with yourself where you are in your journey, and if you have the right to do that based on objectively, is this the path to my success over time?
and
Another,
and
yeah, go ahead.
just one more thing, when we said what stage are you in, and most said stage 1, 2, 3, and if your position size is likely 20% or more, you will likely struggle, and there's a high correlation there. As a stage one trader, if you're likely placing, you likely don't even know the number or the percentage, right? That's the first thing that you want to do in stage one. Stage two, you likely know the number and the percentage, and it's likely too heavy because you're big losses and big wins, right? That means big position sizes both ways. Um, Stage three is where you try to figure it out. Maybe you get closer to that 10 to 15% mark. And then after, when you're in stage four, then it's about maximizing, right? So then 15% or higher, your built emotions, etc. So maybe we'll actually make an update to that diagram that we have and really write out, recommend. I think we will be doing that in future webinars. So
Yeah, and the other thing I want to add is if you're stage one and early stage two, there's no there's no reason to force things in a way, or there's no
shame.
what yeah, there's no shame in trading a much smaller amount of capital
Yeah.
that you have at your disposal, right? If you have 100K that you can trade, whether it's a margin account you built up or a Roth IRA or whatever, when you're building your process in stage one and stage two, you know trade 1K of that. Trade something where you feel losses, but if you lose that account completely or experience a 50% drawdown, you're not setting yourself back financially because, again, it's about process over performance, first of all. And then as you prove to yourself that you can perform, then just like you're increasing your position sizes, you could increase your overall account. That's another way to reward yourself for learning trading and improving over time and all that. So again, there's no shame in trading a lot less as you're learning this. There's a reason we have training wheels on bikes before people, go on the bike pass and while kids are learning. It's because it's to protect you, and it allows you to focus more on technique, because a 5% making a 5% gain in $1,000 account is the same process as making a 10,000 5% gain in 10,000 or even 100K. As you size a lot bigger than that, it gets, some things change, but for the most part the root process is the exact same. So don't feel the need to trade to overtrade your entire account while you're still in stage 1 or stage 2. Yep. All right. Stop buying late, improving entries. This was something that I dealt with a lot the first year I was trading, and I went back and studied my trades, and that's how I realized that this was an issue for me. So again, post analysis is key for identifying a lot of these issues and identifying the root cause of them. Looking back on my trades, I realized that I would enter the right names, the right stocks, but probably 3 days too late, after the stock had already moved 5, 8, 10%. And then what's going to happen after even a leader like Tesla makes a strong move? 5, 8, 10%, there's going to be a natural pullback, natural correction. And I would just get stopped out over and over again. I was like, why is this happening? And then it just takes off without you. Probably a lot of you watching this can relate to that. And studying my trades, I realized, again, I'm entering when it was already short-term extended. It already broke out through the ideal buy point. It already moved off the moving averages. And now I focus a lot more on trying to catch the first momentum move through a pivot or from an earnings gap, getting in a lot earlier because it feels riskier, but it allows you to manage risk tighter. It allows you to get that natural expansion as everybody's kind of joining the trade. So I think it's important to recognize that stocks move between expansions and contractions, uptrends, pullbacks, then new uptrends. And if the stock has already expended a lot of energy recently, it likely needs a natural pause, pullback within the uptrend, and you just kind of want to wait for that and wait for the next setup to occur. So as you're looking for trades, ask yourself if the stock is currently likely to make a large directional move from the current point in time. If not, it might not be the best time to enter because you're not going to get that natural move, from that directional move. And also ask yourself, does this stock realistically have a chance to double from here? Right. I think this is a key takeaway that I learned from you. Are we at a point in the stock's life cycle where it's setting up a base that it could easily make a 40, 50, even 100% move? If not, maybe it's not the time to be watching that stock. Maybe it's later in the move. Maybe that stock just doesn't have that potential. But either way, maybe it's not the best choice for you. Another way to phrase this is, are we early in a stage 2 uptrend? Are we late in a stage 2 uptrend? How many, bases have we had? If you're using the William O'Neill Can Slim methodology, a stage 1, stage 2 base has greater potential than a stage 4, stage 5. So buying late also, is based on the in the moment trade, but also on the larger context of the stock's life cycle as well. And then lastly, before you enter a trade, and this is important, we talked about this, ask yourself if you can place a tight and logical stop loss under support, under a moving average, whatever. And if you can't, again, you might be buying at a moment where it's already moved quite a bit recently and it just needs to set up again. So those are a few things to think about if this is an issue that you're experiencing. Ryan, anything you want to add about buying late?
Yeah.
Things you've
I
seen
I
traders
think
do? Yeah,
It's 11
one one
o'clock.
of the things that like you're likely tracking too many stocks, and you are not concentrated on some of the best moves.
right.
Is if I have 15 or 20 stocks on my focus list, that's not, you can't focus on 20 stocks at once, really, right? You could track them, you could track how they're doing, but if you place 20 stocks on your focus list, I don't know how to buy or track things, in a day, 20 things in a day, right? If we just talk about anything outside of trading. So the fewer that you track, or you feel like, okay, I tracked these 5 stocks, the sixth stock actually was my best performing. There's a learning opportunity in that, and you'll get better at stock selection over time. right? But if you track 20 stocks and you end up catching none of them, or you end up buying late in the ones that you do buy, will hurt you in the long run, right? So you want to balance, again, focus how many stocks you're looking at versus trying to do too much at once again, at the same time when it comes to trading. So I think the biggest mechanism that I see when traders say, hey, I didn't get into a PLTR at the right time before it doubled and my entries, this and that, and then I caught the stop loss and it resulted in a bad trade. All of that boils down to how do you get the best names to be the top five on your screen? And how do you concentrate on those names so that you're buying them at the right time? If you do that, and then there's a feedback loop, right? If those five, there are times where I have three names on my screen. I've been tracking them for quite a while, and when the market gets going, everything else is working and those three names don't work. That's a learning opportunity. It's a market cycle thing.
Yep.
It's okay. It happens. You can't be perfect in every cycle that comes across, right? You go back and you go back to your drawing board, you look at what happened and you tweak things and you get better, right? But if I sat there and I put 30 names, sure as hell I'm gonna, catch 10 of those 30 names are gonna move. But it's near impossible to get really nice entry areas where you can manage risk on 30 names at once. So uh,
Yeah.
shorten those focus lists. Try to go for, like Richard said, he's at five now. He used to be at 10. He's at five. He's trying to size well in the top names, and it will improve your entries essentially. So
Yeah, it goes back to the focus principle that we had earlier on. And right, I don't even know if you were here, but I talked about a big change in my performance and my confidence came when instead of at the open watching 15 names on my weekly focus list, my overall weekly focus list, I decided I'm going to create a daily focus list of 2 to 3 and ideally one or two. That's my focus for the day. And I'm going to get damn good execution on those trades, on those names if I do enter. So I think that's a big shift that you can make here.
that, and also I've seen traders like when they introduced, let's say, relative volume, like Dan Zanger's approach, right? He will only take a trade if it goes through a pivot and has high volume, right?
Right.
That worked for him. It allowed him to concentrate. That's all that it really did. It took a name, if he had seven names on his list, he would trade two out of those seven because the two had more volume going through a pivot than the other five, even though the other five were moving, let's say through a pivot, right? But now he's concentrated on I want a price move with volume, right? And that became his go-to, how he made a ton of money in the markets. So,
Yep,
yep.
exactly. All right, using too many indicators. I think this is a common theme for stage one traders. I know I suffered from this. I used to like to code these dots, these indicators that I would love to code up, and they were a lot of fun to make. But at the end of the day, if you have too many indicators, there's going to be noise, and that's not going to allow you to focus on price and volume, which is the most important thing. So I think that the thing to think about is if an indicator does not help you analyze a chart for an entry or for position management, cut it, take it out of your process. It's just another signal that is confusing your brain and distracting you from what really matters. And a key exercise you could make today is start from scratch, take everything off your screen except for price and volume, and only add back layers that are really essential. And even before you do that, study price action of some big winners like Nvidia last year, and just try to look at the price and volume moves, the expansion, the contraction, how stuff's creates resistance, how stuff forms support, how it acts at that support, and recognize that price action is almost all you need, and everything else is just a guide and there to kind of point out significant things that are already apparent in price and volume. And just all in all, eliminate redundant indicators because there's stuff that looks for momentum moves like MACD and RSI, all this stuff. It kind of is looking for similar things. So having two different indicators that are looking for the same general principle is just adding, again, confusion because then you might not take a trade because the MACD looks good, but the RSI is 40, not 20, whatever it is. And you'll miss that trade or you won't, or you'll take a trade because they're lined up perfectly, but then you're entering late. So I think if you're going to use indicators, and I use a few indicators, I really focus on the ones that are very relevant to how I interpret price action and actually help me with my entries and exits. I think that's key. And what we recommend sticking closely to down here is key moving averages. I like the 21 EMA first and foremost. I know, Ryan, you've got slightly different ones that you watch, but we look to use moving averages that, based on historical analysis, help us manage winners and help us identify winners. The relative strength line, also a very important indicator, helps you determine how stuff is performing versus the market, showing relative strength, standing out in terms of a potential momentum idea. And then lastly, I use relative measure volatility, which helps me, judge contractions and expansions. So all in all, just kind of pick and really focus on the ones that are most important to you and only help your process. We'll keep on moving forward. So some general key principles and exercises to overcome trading problems that you might be experiencing. I think first and foremost, I've said this a few times, write trading rules. This weekend, if you are honest with yourself and need to update them or write your first trading rule set, go ahead and do that. It can fit on a page, just basic entry exit criteria, stock selection, risk management. That's the most important thing. So start with that. Then you can move on from there. Always update it. It's always a living document. Next, do a deep dive in the biggest winners from 2016 to 2025. Again, we have the TraderLion model books that can help you with this. But just look at the top performers each year and go through their charts, bar by bar, and you'll learn so much doing that. Then do a deep dive into a setup you want to learn. But at the end of the day, again, trading problems often come from a lack of clarity and lack of experience. And just over time, as you gain more experience, go through more market cycles, you'll get more seat time experience that allow you to interpret things differently and focus more on your process and system. So overall, just you focus on building a system, habits, setting yourself up for winning position by creating your trading system in a way that allows you to alleviate a lot of these trading problems. So hopefully that was helpful for you guys and gave you some nice practical advice. All right, so a question for you guys in the chat here. Have you written trading rules? Do they need to be updated? If not, my call to action for you guys is to start this weekend. This, again, is your contract with yourself with regards to this business, which is stock trading. You're not going to start and open a store and pay rent if you haven't figured out your business model. Likewise, you need to figure out your business model for trading so you can actually approach this in a professional way. So let's see the answers here. I see some yeses, which is great. Rules need updating. I think that probably applies to a lot of people. So that's something you could do this weekend as well. Thanks for the participation, guys. And put in the comments as well what you're kind of working on to improve your written trading rules.